Morning, everybody. Welcome to this BetaShares Portfolio Construction webinar. This event's been designed exclusively for New Zealand advisors, and we'd like to thank you very much for attending. Just before we get into it, just a couple of important points. Firstly, for those of you who are not familiar with BetaShares, we were founded over 10 years ago, and we currently manage $23 billion, or just over, across 64 different ASX-listed exchange-traded funds. So we'll aim to go for around 35 minutes today, and then allow a bit of time at the end for Q&A. Please use the question function, which you should see on your screen, to ask any questions. We'll try and get to all of them today, but if we don't, we'll certainly follow up with you after the session. Today's session is also being recorded, and you'll receive a link afterwards so that you can watch it again at your leisure or share it with colleagues. And we'll also email out your CPD confirmation to you after the event. So just turning to the important information we need to share before we get into it. Please note this content's for New Zealand advisors and wholesale investors only, and nothing in this presentation should be construed as personal financial advice. And as always, past performance is not a guarantee of future returns. Okay, so I'd just like to introduce you to today's speakers. For those of you that don't know me, my name's Thom Bentley, and I joined BetaShares in May this year. BetaShares is now the only non-New Zealand ETF issuer to have a permanent presence in New Zealand, and I think this really demonstrates our commitment to the New Zealand market. With me today, I've got Chamath De Silva, who's a senior portfolio manager at BetaShares and also a member of the BetaShares Investment Committee, and also Cameron Gleeson, who's a senior investment specialist at BetaShares. Both Cham and Cam are based in Sydney. All right, let's move on to the agenda. So what are we covering today? Firstly, why have a strategic asset allocation approach in the first place? What are we trying to achieve when we set a strategic asset allocation? What are the key objectives and outcomes we're looking for? We'll then move on to cover some of the potential pitfalls of implementing strategic asset allocation via active managers, and flowing on from that, really look at whether there are better building blocks that we can use for implementing a strategic asset allocation approach. And finally, we'll look at some of the key considerations for New Zealand advisors and investors when constructing portfolios, particularly around equities. Okay, so why implement strategic asset allocation in the first place? Maybe go straight to the next slide, Cam, if you can. Thank you. So some of you, or many of you, may have seen a version of this chart before. This is from a seminal paper published in 1986 by Brinson, Hood, Biebauer. Really, they found that investment outcomes are largely determined by decisions on which asset classes to use and the weightings to those asset classes. So you can see here that Brinson et al. Found that around 93% of a portfolio's movements over time can be explained by asset allocation and market movements, with only around 6.5% being explainable by security selection, market timing, and other factors. So what we're really trying to do with strategic asset allocation is align portfolios with client investment objectives and time horizons, with a view to optimizing risk and return. Clearly, if investors had an unlimited appetite for risk, we could simply implement 100% equity portfolios at all times. But as I'm sure you'll all know, investors don't have unlimited appetite for risk, and this really dictates the use of multi-asset portfolios. So, setting the scene, we know that asset class exposures drive the vast majority of risk and return over time, and flowing on from that, constant exposure to a particular asset class is a more reliable way of generating returns over time than security selection or market timing. So with that scene set, I'll now hand over to Cam, who's going to dig deeper into some of the different approaches for selecting strategic asset allocation building blocks. Thanks, Cam.
Thank you, Thom. So, I'll talk a little bit about the alternative using rules-based, or what we might refer to as passive investment vehicles versus actively managed vehicles within the context of your SAA. But before I do that, we should really sort of set the scene in terms of how we benchmark ourselves. What are we looking for? What are the characteristics that we actually want to see in funds that we use really to achieve our target SAA? And at a bare minimum, the first point on this slide really is around the need to fulfill the particular asset class exposures in accordance with that defined, that target SAA. So each building block should look to provide that diversified exposure to that asset class, so minimizing stock-specific risk, and also ensuring that that building block remains consistently invested in the asset class across the market cycle. Transaction costs and turnover are a bit of a killer for portfolios in terms of a drag on performance. We want core or SAA building blocks that are going to be able to be held over the long term. So aspirationally, at least, we should be seeking funds that can be held for 5, 10, or even 20 years within the core of our portfolio. So therefore, robust across the market cycle, very predictable behaviour. The fourth point there is self-apparent, but compelling net of fee value in terms of performance outcomes. But I think the last point is worth dwelling on. When we're looking to build portfolios, we do see some challenges that perhaps are more acute than 20 years ago. If we look at, say, central bank intervention in fixed income, if we look at the degree to which we've got integration of the global economy, this has meant that growth assets, so using global equities, is less effective for diversification purposes within our portfolios. And then within the defensive side, obviously the equity diversification power of duration of high quality government bonds is somewhat reduced. And so we can no longer really sort of adopt this approach of just looking at our portfolio as separate buckets of asset classes and filling each bucket in isolation. We've got to think about the interrelations between asset classes and where we can drive diversification even within equities. That's sort of a really important point for portfolio constructors these days. Sort of talking about active versus passive, this slide here is a summary slide from SPIVA, S&P's Index versus Active Manager Scorecard. They run this analysis across global markets and across those regions, across timeframes, across asset classes, and they look at active managers in each of these regions, and they track their performance versus headline benchmarks, which we can sort of see here in the bubbles. What they've generally found is that there's a pervasive underperformance versus benchmarks from active managers on average across all regions and timeframes. We see here in each of the bubbles the way that SPIVA reports this. They actually show the proportion of funds which are outperformed or beaten by benchmarks in each of those regions. And so, clearly there's a risk around using active managers. It's relatively well known that on average passive beats active. So one approach that investors take to try to minimize this risk is, rather than trying to pick a single active manager, is to diversify across active managers or active management strategies. And this is seen as a way of obviously not holding all your eggs in one basket. We taught that diversification is a good thing. The risk with that, or the issue with that, is that when we have a collection of active managers that all have perhaps some level of active share, that collection can often result in offsetting of active shares. And so what we end up seeing is an outcome that we've got on this slide. So this shows on the left-hand side the 5 largest global equity funds, Australian domiciled global equity funds, as at 5 years ago. And we track their performance over that 5-year period, all the lines in grey. And just out of interest, the line that's actually sort of outperforming for much of the period is in fact Magellan Global. Out to about September, we then see that fund unfortunately is now underperforming over 5 years. But we've got that dispersion of returns. Overall, if we were to hold an equally weighted basket of these funds, we in fact see a return profile which has very similar risk to the overall market and very similar performance, less a performance drag. And just out of interest, that cumulative performance drag over the 5-year period is about 20%, so pretty substantial underperformance versus MSCI World. So it points to sort of some of the problems we face in terms of using active managers in terms of long-term core. when we think about this issue and the fact that active managers, can outperform on a yearly basis, but if we extend our investment time horizons, we tend to see a greater degree of underperformance. What are the drivers for that? Chief among them, I would suggest, would be the impacts of compounding. There sometimes is a bit of a misnomer that the reason why we see average underperformance is because the majority of active managers are bad, they underperform consistently, and we've got a small group that perhaps outperform consistently. However, there's a lot of work done in terms of the persistence of active management or active alpha, and we see that active alpha is actually quite transient. So what that means is when an active manager has a good year followed by a bad year, we don't get a compounding effect from that alpha, if you like. That we see that the positive returns one year are then offset the next year. We don't get that compounding. Whereas fees and costs and active strategies typically are higher cost load, even in terms of their internal trading costs and their management fees, obviously. That's always compounding in the wrong direction. It's always eroding your capital. So that's somewhat of a explanation for the degradation of long-term performance from active managers. One of the real challenges for investors when using active managers, as opposed to using a benchmark or index tracking approach, is the conundrum that we all face when we've got our favorite active manager and they've done well for a number of years. They start to underperform. Thom, just to vary the speaker, I might invite you in just to talk about that briefly.
Yeah, thanks, Cam. Yeah, look, I mean, this really stems from a number of conversations I've had with advisors over the last few months. And, Cam mentioned a particularly high-profile active manager that's really started to underperform quite materially. But, one of the conundrums that advisors face in this situation is, when do you switch, or when do you exit one manager? And if you exit, which manager do you go into? Do you choose simply the best performing manager over the last 5 years, which, as we all know, is not necessarily the right approach. So, that when you're talking about sort of the core portfolio that you're constructing for clients, that sort of conundrum is probably not helpful. So, it's another reason why we really think, we'll come on to this, but why we really think that, when you're building a sort of core strategic asset allocation approach, it makes more sense to have funds that are tracking an index rather than active funds. Thanks, Cam.
Thank you, Thom. So, look, I mean, I should stress that not all active managers that are available in the market have underperformed over that last 5-year period. And there's been, a number of notable exceptions. What we actually find is, if we look at where the large inflows from the last year have been, these have typically been managers that have had good 5-year returns. It's sort of somewhat unsurprising. As humans, we're performance chasing. What these funds tend to have in common is that they tend to have a growth style of investment strategy, and many of them take what's known as a high conviction approach to investing. If we look through the portfolios of these funds, if I take, for example, just the top 3, very much skewed to tech or tech-oriented companies. And that introduces a lot of stock-specific risk. They also, in being high conviction managers, introduce a lot of single stock risk. These are really questions that we must consider if we're thinking about this from a long-term strategic asset allocation. Is taking these biases appropriate in light of what else we have in our portfolio? Now, I mean, another couple of points to make, obviously, is that many of these managers are very high fee and often include an outperformance fee. And we'll talk a little bit about that on the next slide. But when we look for outperformance from an active manager, ideally we want to see outperformance which is driven by their ability to pick stocks, to generate alpha, which can't be replicated elsewhere. But in fact, what we find is with a lot of these growth managers, their outperformance versus a benchmark like MSCI World is really driven by their style bias, their tilt to, say, quality or growth, and then also potentially taking on increasing risk rather than that stock picking ability, which is what a active manager should in fact more be used for. So, just looking at an example, and this is in the grey line or the grey shaded line in the background there. we see the best performing out of these funds, and we've it's done incredibly well, like around about 23% per annum, going back to the start of this chart. Whereas in orange, we're showing there the BetaShares NASDAQ 100 ETF. So this is simply an ETF that tracks the NASDAQ 100 index tracking approach. The fund, shown in grey, is incredibly tilted to invest almost exclusively in tech and tech-related stocks. Its portfolio is largely made up of the leaders from the NASDAQ 100. It does have, although I will say in terms of deviations for the NASDAQ 100, it has some quite large stock-specific bets, in Tesla in particular, also in Square, and Spotify is another name where it's quite overweight. So it's largely skewed towards NASDAQ or tech, but with some stock-specific bets. Those stock-specific bets have in fact done very well for this fund over the last couple of years. It's, obviously those stocks have actually outperformed the NASDAQ, so that's been good for the fund, or at least good for the underlying manager. I talked before about outperformance fees or performance fees. So this fund has a benchmarks for its outperformance fee of the MSCI World Index. Many people think that a performance fee aligns an investor's interests with that of the manager, or the manager's interests with that of the investor. That's true to some extent, but the issue that we face when we look at performance fees is, from a manager's perspective, a outperformance fee or a performance fee is very much like a call option written by the underlying investors. The issue I have with performance fees in a fund like this is that the asset manager gets to decide the riskiness of the underlying portfolio. And so by skewing to tech, by taking a lot of stock-specific risk, they're increasing the riskiness of that portfolio, which automatically, if we think about option pricing, increases the value of that call option. And this manager's generated an enormous amount of revenue as a business through performance fees over the last couple of years. In fact, the outperformance of those single stock names like Tesla and alike, that's clearly, if we look at the similarity of the NASDAQ versus this fund, has eaten away any outperformance over and above the NASDAQ. So the outperformance fee paid to the manager has meant that the performance of the fund is then reduced back to where the NASDAQ is. So I guess my question is, if you're getting a return profile very similar to the NASDAQ, then why take the additional stock-specific risk? Why pay an active manager, huge performance fees? And one of the reasons why I say that is this chart goes up to October of this year. If we look at the month of November, some of those stock-specific bets are substantially down. So I think if we look at Spotify, Square, they're both down about 16% for the month of November to date. Tesla's down. This fund doesn't hold Nvidia, for example, which sits in NASDAQ, which is up 25% for the month. And the fund's now down 5% versus NASDAQ for the month. So you're introducing a lot of stock-specific risk, which works well when those stocks run, but inevitably there'll be periods where you underperform, and the active manager doesn't necessarily pay back their performance fees in those times. So that's just a really interesting case study of a manager who's quite popular due to their performance. I do want to stress that when we're talking about index tracking or rules-based approaches, we don't necessarily need to limit that to market capitalization or beta style exposures. We should be quite specific in seeking complementary exposures, and a growth exposure like what we talked about on the previous slide may well be appropriate for a particular portfolio to complement what else you hold, to add diversification. So the chart on the right-hand side here shows the performance of that equally weighted basket in light grey and MSCI World from a few slides ago. So there's active managers as a basket versus MSCI World. And then we've overlaid that in orange with our BetaShares Global Quality Leaders ETF, which is a factor or a smart beta approach to investing. Now, I think smart beta and factor investing styles, because they're offered through a rules-based approach, usually very low cost, can also add real value, as I talked about being complementary. Quality or QLTY, tracking a high quality basket of stocks. This is stocks which we've got a rules-based approach for identifying stocks that are highly profitable, low level of leverage, high cash flow generation, very stable earning stream. This can be very complementary in providing a quality growth tilt to your portfolio where you have perhaps other investments that lack that sort of attribute. That's just one example. Another real use case for rules-based approaches is within the ESG space. And within Australia, our rules-based ESG funds have been adopted very widely. We've received the majority of inflows across ethically managed ETFs, and we're in fact the second largest manager across both active unlisted and listed ethical exposures. And so that's another real use for rules-based approaches is in the ESG space there. In terms of the advantages of the rules-based building blocks, and I want to sum this up and not talk too much specifically about historical performance, but obviously the lower cost, and that's not just limited to management fees, it also includes internal trading costs. And also we typically see that ETFs trade with tighter bid-ask spreads often than unlisted active managers. Control over risk management. Rules-based approaches tend to reduce stock-specific risk. They tend to provide exposures which are more consistent over the market cycle. And we also know that rules-based approaches usually will see almost 100% of assets deployed in the particular strategy that they're looking to emulate, the index they're looking to emulate. There's very little cash balance, whereas an active manager, we've seen active managers take very big bets into cash, for example, or to go short particular sectors depending on their mandate. So it's control, it's ensuring that your asset class, your strategic asset allocation is being fulfilled. Better rear vision mirror. I think we've all been there with an active manager trying to understand why they might have underperformed, reading a performance report which has some limited commentary, shows maybe the top 5 stocks. With an Australian listed ETF that tracks an index, the ETF provider discloses all portfolio holdings on a daily basis. And the index itself, the performance is tracked versus a zero cost, the fund itself is tracked against a zero cost index, so no friction. So we can immediately understand where performance has come from. We can do proper performance attribution. We understand the exact drivers of returns, and we know all of the elements of where all of that costs have come from versus that zero cost benchmark. Finally, all those attributes combined mean that we have, given that that rules-based approaches make for more consistently behaving building blocks, we've got funds that we can use that are going to more complement other portfolio holdings and act more consistently throughout the cycle. So really good in terms of combining assets across our portfolio. With that, I'll hand over to my colleague Chamath to talk about fixed income.
All right, thanks, Cam. I might just start off with asking the question on why to index in fixed income over using active management. So as we can see from this slide, which is showing S&P SPIVA data capturing the relative outperformance of Australian active managers versus the benchmark index on both an asset weighted basis and an equal weighted basis, we can see that in aggregate, Australian active managers haven't exactly covered themselves in glory over the past 10 years, with 86% underperforming the broad benchmark index. And not only have active managers or active fixed income strategies on average underperformed the benchmark over the long run, but this underperformance has been most acute during periods of market stress and equity drawdowns, as seen in the red bars. For example, during the GFC, during Q4 of 2018, and most recently during the COVID crisis of Q1 of 2020. You can also see from the chart that active strategies have tended to outperform in the post-COVID period. But we should also remember this has been a time where risk assets, especially equities, have actually performed very well. So active fixed income strategies tend to be more correlated with equities than the benchmarks because active managers tend to be structurally overweight credit risk and they tend to be structurally underweight duration or interest rate risk. The two charts in this slide are taken from an AQR study on active fixed income alpha, and it really shows a very high level of correlation between active returns and the returns on credit in fixed income, based on both US and global fixed income strategies. Ultimately, we feel that fixed income should complement the rest of your portfolio and not double down on the same risk factor. In addition, you shouldn't be paying active fees for more equity-like risk in what should still be your defensive building block. Furthermore, active managers don't know what else is in your portfolio, so they won't be able to manage duration and credit risk in a way that best serves your investment objectives or in a way that truly provides portfolio diversification. So how should we think about indexing in fixed income? So in equities, broad-based market cap weighted indices can easily serve investor needs in many cases, supported by low costs and low turnover. However, we argue that the same rules don't necessarily apply to fixed income. Ultimately, the choice of fixed income index should be to serve the overall portfolio, and the optimal fixed income exposure for you and your portfolio may not be the broad market cap weighted or debt weighted universe. So why should we be cautious about using a broad debt weighting or liability weighting in our fixed income indices? You know, that is indices that capture the entire universe of bonds, such as the Bloomberg New Zealand Composite, the Bloomberg Ausbond Composite, or the Bloomberg Global Aggregate. You know, liability weighting allows issuers to set their own weight in the index with issuer preferences and not investor needs determining the risk profile of the index. In addition, liability weighting results in an unstable risk profile of the building block, stemming from either duration risk, such as fluctuations in the average maturity of the index, or segment drift, such as the split between government and corporate bonds changing over time, which can potentially undermine equity diversification. Also, broad benchmarks typically don't adjust for free float or central bank holdings, meaning that indices could contain extremely inefficient parts of the fixed income market from the perspectives of both excess returns over cash, but also diversification benefits. Ideally, we want our strategic asset allocation building blocks to have stable risk profiles over time, and we want our building blocks to best complement the rest of our portfolios. The two charts shown in this slide illustrate what I mean by unstable risk profiles. The chart on the left shows a modified duration of the Bloomberg Global Aggregate Index, which has been in an uptrend over 20 years, reflecting a lengthening out of the average maturity profile of new issuance. The chart on the right shows a composition of the global investment grade corporate bond universe by credit quality, specifically ratings bucket. And we can see a deterioration in the average credit quality over time. As you can see from the chart, the lowest tier of investment grade, shown in the green bars, which is Baa for Moody's, which is equivalent to BBB for S&P, only accounted for a relatively small share of corporate bonds outstanding in 2001, but now accounts for around half of all investment grade corporate bonds outstanding. And I'd like to emphasize this point. Fixed income shouldn't be one size fits all, but ETFs now provide fairly granular building blocks to assist with constructing tailored defensive solutions to serve the overall portfolio, whether it be income, capital stability, or equity diversification. The visual here shows the BetaShares fixed income building blocks covering interest rate risk exposures, such as government bonds, credit risk exposures, such as senior bank floating rate notes or floating rate bank hybrid securities, and exposures that contain elements of both interest rate risk and credit risk, such as fixed rate corporate bonds. So whatever your portfolio needs to get out of fixed income, there is likely an ETF listed on the ASX that's suitable. And just coming back to the key point that fixed income should be looked at holistically and not in isolation, the quote unquote best fixed income exposure really depends on what else is in your portfolio. Your overall investment objectives, your time horizon, and your risk tolerance. For example, a portfolio with a relatively small equity allocation and an investor that requires income may benefit from a high allocation to corporate credit. versus, say, cash or government bonds. In contrast, a portfolio with a larger equity allocation and an investor with a longer time horizon or a longer investment horizon may find greatest benefit from using long-term government bonds as a portfolio diversifier. And I'll just emphasize that duration or interest rate risk isn't something you should fear, but it should be selected with your specific investment horizon in mind, given we typically get compensated beyond cash for taking on some degree of interest rate risk. Also, given we're currently seeing rate hikes in New Zealand and rate hike expectations building globally, it's easy to assume that bonds won't perform well. However, it's also important to remember that what's bad for bonds isn't necessarily rates rising, but rates rising by a faster pace than what's already priced in to the yield curve. And with that, I'll hand it back over to Cam.
Thank you, Chum. Yeah, so look, I mean, I think this last slide is actually quite interesting. If I look at the client or the investor on the left-hand side, that's what I would describe perhaps an investor with a lower equity allocation. It's more likely to be an investor with a defensive risk profile. And what we're suggesting on this slide, obviously depending on the investor's circumstances, would be an increase in risk in terms of upweighting credit being more risky than government bonds. So it's quite interesting that a more defensive investor might seek within their fixed income portion a riskier allocation. It's somewhat counterintuitive in some ways, but this is what we talk about when we're referring to the interaction between different parts of your portfolio, the need to take into account what else is in there, and that investor who is defensively oriented, potentially they're in pension phase, their key risk may well be inflation, due to their inability to earn an income anymore from salary, and so credit will assist in terms of driving a higher return to ideally beat inflation over a period of time. So it's just a really interesting example. I'll run through a case study now, just a really simplistic case study looking at an example of a New Zealand investor and how they might look to build in some diversification from global equity exposures. So the first chart here I show here is the sector allocations from, in black, the New Zealand 50 index. In yellow I show the Sole Active Australia 200 index. It's essentially the same index as the S&P 200, but it's an index that we use, so I'm just using them to promote that particular index. And then we show the MSCI World in grey. Now, turning to the New Zealand market, and also the Australian market, clearly, there's very, high degree of concentration in particular sectors, and particularly in the New Zealand market, a lot of stock-specific risks. If we look at, for example, healthcare, enormous overweight for New Zealand equities. Across industrials, utilities, and real estate, we see a large allocation to infrastructure and real assets. And so these are sometimes referred to as bond proxies. And that's a large allocation of the New Zealand index in terms of Auckland airports, Infratil and alike. Looking at the Australian market, one thing that's quite interesting, obviously, is the overweight to financials, particularly our big four banks, and to materials. This can be quite complementary for a New Zealand investor, where we've clearly got smaller allocations in the New Zealand market. So that's a good attribute to blend in if I'm a Kiwi investor. But the one area where both Australia and New Zealand are weak is in what I describe as the growth sectors of the market. And they are information technology, communication services, and consumer discretionary. Looking at information technology in particular, we can see their MSCI World allocation of around about 23%. Very small allocations in both Australia and New Zealand to that sector, particularly New Zealand now that Xero's left that index and alike. So this is something to be considered when looking at your diversification. Now, got here performance and correlations. I show the first line is obviously the New Zealand performance, which has been relatively strong. So these are all returns converted into New Zealand dollars. Low level of volatility. Obviously over the last 5 years with falling rates and the level of infrastructure and real assets in the New Zealand market, that's been a bit of a tailwind. Australian index, by comparison, when we convert to New Zealand dollars, has performed has underperformed pretty substantially New Zealand dollars. Now, turning to the global exposures, and I'll highlight the correlations here. Firstly, MSCI World Index. Now, obviously, the lower the correlation, the better this particular building block will be for diversification in our overall portfolio. And this is what I talked to in terms of driving diversification. So MSCI World correlation with New Zealand around about 55, that's great. One point I'll make here is that I've specifically looked to use a unhedged exposure in MSCI World Index. And that's important for both Australian investors and New Zealand investors because our currencies are both what are known as risk-on currencies. So by holding unhedged global exposures, if we have a liquidity crisis like COVID in March 2020, we will typically see our currencies fall. And as a result, holding global equities in currencies like US dollar, Japanese yen, and the euro, that's going to automatically give us some protection or downside protection. And that's a good thing from our overall perspective. If we're talking about an SAA, core portfolio holdings, we shouldn't be looking to express a tactical view on currency, a short-term view. Currencies are notoriously difficult to predict anyway. We're going to be holding over the cycle. Currencies will move up and down. Holding unhedged reduces volatility in our portfolio. So the last index I show here is the index for our BetaShares Global Quality Leaders ETF, which I referred to earlier. This index tracks 150 of the world's highest quality companies. So it gives a quality growth exposure. It's very much diversified exposure, single stock cap of 2%. So it's good as a core allocation. And critically, we see versus MSCI World, we're in fact reducing correlations even further, particularly for the Australian equities. So that'll be interesting. Just a slightly higher volatility, which I'll refer to on the next slide. So look, let's have a look at some portfolios and how these building blocks might help. So just to start with, just the 100% allocation to New Zealand equities. We can see outcomes there in terms of Sharpe ratio, volatility, and risk. But to compare that, I take Portfolio B. So this is a portfolio of obviously half New Zealand equities, but we've introduced a 25% allocation to Australian equities and 25% allocation to MSCI World. Now I highlight the total return here to draw one interesting point out about having a diversified portfolio and periodically rebalancing that portfolio. We often think of the expected return of our portfolio as the average of the return of the component parts. What's interesting here is that the Australian equity market has actually performed relatively poorly to the New Zealand market, and on average, MSCI World and the Australian market have had a return which is actually less than the New Zealand market. Yet, if we are holding a portfolio over 5 years and periodically rebalancing across these three assets, we get what's known as rebalancing alpha. So due to the dispersion of returns in a portfolio where you have less than 100% correlation, what we see is when an asset is bid up, more expensive, and then rebalanced to buy it back in a cheaper asset, we get that attribute known as rebalancing alpha. We often think about the benefits of diversification just in terms of our volatility, but there can in fact be an improvement on our total return. So we've managed to do that to match the total returns of Portfolio A, despite the average return being lower in isolation of each of the components. So that's interesting. Portfolio C is also interesting. I mentioned QLTY's index before having a slightly higher volatility than MSCI World. In Portfolio C, we've subbed out MSCI World and we've added QLTY's index. Have a look at what's happened to the volatility of our blended portfolio. As a result, it's actually lower despite the individual component part having a higher volatility. So this is another important thing to think about when we talk about looking at things in combination rather than in isolation. Higher volatility addition as in fact more complementary to the overall portfolio volatility. And finally, Portfolio C. Look, if we're looking at Fisher & Paykel Healthcare as 16% to the New Zealand market, at 50% weight in your portfolio, that's still 8% to a single stock. That's a lot of stock-specific risk. So I think we'd all agree we'd like to reduce that stock-specific risk, and Portfolio D is just a simple allocation which is designed to capture a sector profile and reduce stock-specific risk, a sector profile which is more representative of really the global opportunity set, what global equity markets look like. And so we've downweighted our New Zealand equities, so reducing a lot of that stock-specific risk, and then upweighting global equities. And we can see there, just at the last point, the Sharpe ratio. So Sharpe ratio reflecting the risk-adjusted returns of that portfolio. So take your excess return over risk-free divided by volatility. So higher the number, the better. And then finally, I'll just show that portfolio D, that last line, that the sector allocations in orange of that portfolio versus MSCI World shown in grey. And we can see that if I look at those growth sectors again, together, IT, communication services, and consumer discretionary, the orange bars in sum total, roughly equivalent to those grey bars. We've managed to match our cyclical exposures across financials and across materials. We've neutralised our exposure across, relatively neutralised our exposure across those real assets and the bond proxies in industrials, utilities, and real estate. We've still got a relatively high degree of allocation, over allocation to healthcare, but even within that stock-specific risk is far reduced. So this, given if we think of the unconstrained global equity market as a more holistic view of the opportunity set, I'd suggest this is a more balanced portfolio, and we saw some of the positive outcomes on the previous slide there. With that, I'll hand back to Thom.
Yeah, thank you, Cam. Excellent. So just wanted to round off quickly, just with a little bit of insight into the use of exchange-traded funds, ETFs, for implementing the strategic asset allocation approach. So if you could move to the next slide, perhaps. Thank you. So, look, I should preface this by saying, obviously, BetaShares is an ETF issuer. And we believe that ETFs offer some important advantages to investors when implementing a strategic asset allocation approach. But I think I'd also just point out here that it's important to note that ETFs can be index strategies or active strategies. So we're not talking here about active versus passive. We're talking about the structure of an ETF. And that's what's important, not necessarily the underlying strategy. So, what are the advantages of ETFs? I think Cam referred to this earlier, but, firstly, transparency. So all of our ETFs, all of our index ETFs publish full portfolios daily. Interestingly, in New Zealand, the only ETF issuer in New Zealand is sort of still coming under that traditional managed fund transparency structure. So, they only issue the full portfolio once every 6 months, and that's generally a few weeks out of date even then. So, it's quite a different approach that New Zealand ETF issuers are taking. So transparency is one of the key things. You know what's in your portfolio all the time. Liquidity is really important. So ETFs have 3 levels of liquidity, essentially. Obviously, there's the on-market liquidity, so what's available, if you like, on the screen. Secondly, ETF market makers hold inventory. So think of that as the warehouse. So typically, ETF market makers have inventory as well. And then finally, you've got the underlying assets, whether they're shares or bonds. So there's 3 levels of liquidity there, which means that they're highly liquid. Obviously, because of the intraday pricing, the value of your holding at all times. As Cam said earlier, ETFs typically are fully invested, at least the index strategies are. So when it comes to building a strategic asset allocation portfolio, you don't have to worry about residuals like cash or shorting, and how you take account of those in your asset allocation. And finally, typically fees are lower in index ETFs versus actively managed funds. So there are some key advantages there that we see for ETFs. And just on the point of changing asset allocations, one of the key advantages of an ETF when you want to change asset allocation, say if you want to move 5% of your portfolio from equities into bonds, in an ETF structure, you can do that instantaneously. You sell the equity ETF, you buy the bond ETF. Your exposure starts at that point in time. Obviously, the settlement's T+2, but your exposure changes instantaneous. In the unlisted world, you have to do a redemption request. You might get the money a couple of days later, and then you've got to then apply for the new fund. So you might be out of the market for up to a week. As we all know, a week can be a very long time in markets. So ETFs really allow you that sort of pinpoint ability to transact. Thanks, Ken. If we could just move on. Thank you. So look, just bringing this all together, I think it's pretty clear that strategic asset allocation plays a fundamental role in long-term risk and return outcomes. We believe that using well-diversified, low-cost building blocks for strategic asset allocation gives you more control over both costs and outcomes. Rules-based building blocks in constructing portfolios gives you less chance of unintended outcomes or unintended risks. Following Cham's session, really important to note that fixed income doesn't need to be, and probably shouldn't be, a one-size-fits-all asset class. You can deconstruct indices into their component parts, and it's really important to think about what the fixed income allocation is there for in a portfolio, and just using a global ag type approach is not necessarily the right way to go. ETFs are really great tools for implementing and changing strategic asset allocation. And finally, we offer a wealth of resources to help you. So if you go and visit our website, you'll see, if you visit the advisors and institutions section there, you'll see some great information. I'll just round off by saying we also offer what's called a Portfolio Plus service. So if you're interested, we can analyze your current sort of client portfolios and assess them to determine where improvements might be made. We're certainly not going to suggest improvements if they're not warranted, but that's a service we can offer you that really drills down into a portfolio, gives you some really good analytics on what you currently hold, what your exposures are, and how those might be improved. So please do contact me if you need any more details there. Thanks, Kev. We can just move on. So we've got time for just a little compliance slide, I guess, but obviously, there is investment risk, no guarantees as to future outcomes. This is general information only, and please do refer to the relevant PDS if you want more information. We'll just move on to the Q&A. We did have one question around the fixed income part of the section. Do we have any fixed income funds hedged into New Zealand dollars? The answer is we don't currently, but we will. And you'll get more information on that in the new year, but that's certainly something that's on the way. So we're definitely looking at launching some New Zealand dollar hedge versions of our fixed income products. We're just conscious of time. Just one other question, perhaps I might throw to Cham on this. Cham, inflation's a major concern for markets right now. What are your thoughts on positioning multi-asset portfolios in a sort of rising inflation environment?
Yeah, I mean, inflation's probably the most topical issue right now. Not just in New Zealand, but probably globally. But ultimately, when we're thinking about core and strategic asset allocation, we think that portfolio should be constructed with an investment horizon that's likely to span beyond the current business cycle, the current interest rate cycle, or the current inflation cycle. And I'd also caution against making wholesale asset allocation changes based on the current narrative. And just with a specific mention about inflation, a lot of supposed inflation hedges can be somewhat unreliable. Given inflation risk isn't easy to define. Inflation risk could be the risk of current inflation, it could be the risk of inflation expectations rising, or it could be the risk of an aggressive central bank response to current inflation pressures. And depending on which type of risk to hedge, it might require a different instrument, but ultimately we really don't know in advance. So I think, with SAA portfolio construction, it should be there to serve the entire investment horizon across multiple cycles. And I'll just finally add that, inflation is, the current macro narrative, but macro narratives can be fickle and they can change pretty quickly. Inflation's in focus right now, but it might not be in 12 months' time. And I'll just reiterate that SAAs should aim to cut through the noise and narratives and focus on our long-term objectives, our investment horizons, and our risk tolerance.
Excellent, thank you, Cham. So look, we're pretty much just running a little bit over time. So I'll just wrap up by saying, thank you very much indeed, everybody, for attending. Cam, if you could just flick to the next slide. I'll leave our contact details on the screen there. So I suggest, if you want anything, please contact me in the first instance, and I can pass anything on to Cam and Cham if we need more expert input. But please feel free to get in touch. Thank you again for attending, and enjoy the rest of your week and have a great Christmas and New Year break. Thank you very much, everybody.
Thanks, everyone.